Get my dollar trade playbook to learn how to position, profit, and protect during a dollar devaluation. Scan this QR code or click on the link in the description. Hey, greetings all, and thank you for joining us for Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by our options mentor, Hans Albrecht. And we are going to come and talk about a little bit of the market moving reasons for us to get still wrapped up in this valuation euphoria, AI excitement, rate cutting backdrop. But first, let me just kind of highlight a few things. Yesterday, it was kind of interesting because in my live trading room, I noticed that liquidity and breadth had been falling, but every headline seems to just save it exactly at the right moment. And yesterday was Besant coming out talking about how Fed should and likely will cut rates by 50 basis points in their September meeting. And this is deja vu because we literally just talked about this last time, where I have this big post about employment when we had a big hit for revisions on August 1st, and we hadn't had such a big revision since the prior year for a non-payroll print, where in that fateful August 2024, they BLS revised job growth by 818,000. And that prompted the 50 basis point surprise rate cut by the FOMC at the very next meeting, because Fed has two directives: price stability and labor market stability. So it was going in the wrong direction. Now, irony, I'm speechless talking about it, but on the same day as this year's BLS non-farm payroll report, that director was fired on the spot. They now have a new director who is threatening basically to withhold non-farm payroll monthly data until he understands the system better. So that means no transparency. And that's very kind of third world, or all the China criticism. The jokes write themselves. Anyway, the point is that this market loves loose monetary policy and all gas, no brakes fiscal policy and an AI narrative that sets all buyers, no sellers. So we basically have this backdrop where we had Besant coming in saying they're going to cut 50 basis points. Well, the only way that they really should is if the employment situation is deteriorating, right? But we're not going to know because they're going to withhold the jobs data. So we're just going to basically be told to trust them. That's a hard sell for many economists. But the other surprise was in Bloomberg interview, Besant came out, and this is really important because I've actually kind of sized this up for a few months in advance of mortgage rates falling and this kind of refi wave, small, not large like 2020 or 2009. But the point is, I have been betting on this refi wave that's going to hit mortgage originators. So long story short, he came out in an interview where he says overall the Fed funds rate should drop by 150 to 175 basis points. Now, we're not going to debate this in this session because it just happened today, and basically it's a really big kind of macro trigger for a big Fed overhaul and a rate regime that is supposed to help loosen up kind of mortgage refinancing, which unlocks lots and lots of home equity owners, home equity value. So it really does create a lot of run it hot and more liquidity into the market. But the market, long story short, the stock market took that interview point and went, whew, hot fire flame. So now we're pushing into 6,500. And it's funny because in June had posted, okay, price targets that were gravitating towards 6,500, little shake and bake, 7,000. We could even get stupid into melt up territory, right? We talked about this 8,000, 8,200. But I have a lever for that needs to trigger that has not triggered yet. So we're not yet in melt up. Maybe individual stocks, yes, but not yet the market overall. But anyway, getting back to this kind of market thought of hell bent on 6,500, which was a Market Thoughts post title. I'm changing it. It's hell bent on SPX 6666, because now that's where, of course, we've 10x'd from the bottom of March 09 at 666, and many are kind of placing their bets that we're going to reach that sooner rather than later, before any shake and bake. So anyway, just want to kind of preface that backdrop as it relates to Besant really adding tons of promises and or BS, however you want to read that, that's up to you. But the point is the market loves rate cuts and they're going to be pricing in more of them. And that's what's driving some of this outsized run. Okay, so I just wanted to get that off my chest because we don't have CPI to interrupt, in other words, inflation spike to interrupt a growth scare. We don't have unemployment, we'll have jobless claims tomorrow, but we won't have non-farm payrolls on a monthly potentially to also interrupt this momentum and trigger a growth scare. So we're kind of a bit running blind, which is very disconcerting and for economists, very upsetting. But bond market, show us you care. And so far, they have not. All right, Hans, what's your take on where we're at macro to micro and where does this market train start to slow or go off the tracks?
Well, I raised my 6,500 target to 7,000 this week. So I am on board. I'm playing the game. I just don't see, I mean, the bond analysts are confused. I'm not sure what there is to be confused about. This market, they're throwing fuel on the fire here. As you said, it's all gas and no brakes. The market didn't need 50 basis points. It didn't need any more reason to keep going. AI is enough of a reason. Productivity, promises of productivity are enough of a reason. The Fed already thinking of cutting 25 basis points during a relatively strong kind of a PMI outlook. If you cut into a non-recessionary type environment, markets do that just fine. So you've got all kinds of things going on, potential for margin expansion from productivity. So I think we're entering into, and I've mentioned this a few times, where it is almost like a known unknown. Entire market, you sort of point to stocks that don't have earnings and go, well, I don't know what they're worth. And so they can be worth anything. And so the market is kind of absorbing a little bit of that in a sense, because nobody has any idea. Analysts have no clue. They think very linearly. They look, oh, well, what's growth been the last little while? Well, I'm just going to extrapolate and look at, well, that's what growth is going to be. No, they're not even close. They're so off the mark. They have no clue what's going to happen here from this AI inference stage that is going to infuse the economy with unbelievable, but almost incalculable benefits. We don't know exactly where it's going to be, but it's what it's going to be. And so that really makes this very, very difficult to put your finger on. And right now, the market is saying that it's glass half full. I don't see why it would say glass half empty unless we saw a real big drop in employment, which is, of course, always a possibility at some point because you can't just sort of fire half your workforce because you can use AI agents now without some sort of impact happening. So I think the speed with which this sort of occurs over time is going to be very important because there is this sort of theory that, well, if you create this productivity boom, you're going to unleash all sorts of other things that lead to perhaps other roles for people and new innovations and all that stuff. I mean, that's kind of how things are supposed to work. But can you retrain people fast enough? I really doubt it. AI really moves very quickly. So, but that's down the road. The market is not really worried about that at this point. And so 900 points ago, I said, look, we're probably going to melt up. Of course, everyone was talking about, well, in the fall, we're going to worry about people saying, well, is all that there's going to be softness in the economy. And I said, no, everyone's going to say, well, that was just because of the pull forward. And then they're going to look to regulation. They're going to look to rate cuts. They're going to look to all these nice things that are going to be happening, the positive promises from this administration. And then AI is just going to start juicing everything up. And so that's what's happening. Now we've had sort of the mechanical move. And in fact, I would have said probably around 6,100, that mechanical move has sort of played out in terms of those vol targeting funds, those kinds of funds that kind of had to get back in. They're kind of topped up at this point. And I remember at that point, I said, well, at that point, you've sort of had the short covering. Certainly not by any means has the smart money gotten back in. They have gotten this so wrong, it's not even funny. So there's still some money to come back in from all the very smart people who got out and thought we were heading into a global recession. So they're starting to push back in, realizing what's happening with AI and rate cuts coming. So you kind of have that sort of playing out. But I said, listen, we need to start seeing something real at this point. It can't all be sort of mechanical and short covering and being on the wrong side of things. Remember when the Russell was shorted, like I don't think we'd ever seen short positions like that in the Russell, not in a very long time. The downside skew was off the charts. People were buying puts and betting on the end of the world with the Russell. And so there's been just this kind of unraveling of really bad bets. And now we do need a bit of reality. We need the economy to be stable. We need unemployment to not rise very drastically. And we need this sort of promise of AI to start to work its way in. And the market is giving the benefit of the doubt to all those things potentially playing out at this point. And I think it's very difficult to kind of figure out, well, I wouldn't want to be an analyst sort of figuring out, well, I don't know what's going to happen to Salesforce. Like, look at that chart. I called those 6 weeks ago. I said short Fiverr, Salesforce, Adobe, Upwork. They've all gotten crushed as markets make new highs almost every single day. So there's going to be disruption. Not everybody is going to win in this particular phase of AI and economic reality. It's going to be disruption unlike we've ever seen. So we don't quite know how that's going to play out, but it's going to be very, very interesting.
Well, I have definitely written about this winner take all mentality with the big tech earnings prompting why folks think the market is recession proof. And of course, unemployment will upset that apple cart greatly, assuming we have transparency on employment. AI right now greater than Powell, no rate cuts for you, Mr. President. Remember that post? And the coming US AI tech jubilee. Now, I can poke a lot of holes in that thesis as it relates to Capex spend historically, as it relates to China's dominance in AI tech, on and on and on. But naysayers be damned, we still have the speculation that is driving the market higher, and that's the risk for a melt up. We haven't even gotten into a melt up yet. But as it relates to the mechanical buying, I did write about this as well, saying no, we don't have an exhaustion in mechanical buying. We were at, in fact, I have it right here, Monday, July 28th, bullish flows, discretionary and systematic flows are at 51 and 69% respectively. So that's not topped out. So we still have a lot of the bullish backdrop, but I'm not justifying it or saying be blind and complacent. And, the fact of the matter is, I have been very, very focused on my growth rotation. And until we get a macro trigger and a macro event risk or a macro trigger to interrupt the bullish flows, that growth rotation can continue. And it has. So I showed you that last week as well, saying I don't show this very often. I show it to clients every single day, but it has been my guardrails as it relates to this market advance. And it is in rarefied air, meaning all-time highs. So my growth value rotation is in fact in all-time highs. And what's my rule of thumb with all-time highs? You don't short all-time highs, buy all-time lows. You don't until it forms a pattern or you see underneath the surface breadth degradation and or selling. And my indicators, like I said, they keep getting a stick save every time they start to want to sell off. The market wants to take profits because the valuations are so extended. Boom, Basent comes in with another headline like Fed's going to cut 50 basis points, and then you see small caps spike higher and make up a month worth of losses. So or going sideways. It literally, we were 7 weeks, 1, 2, 3, 4, 5, 6 weeks of absolutely going nowhere fast. And then the last 2 days, boom, on that comment. And then doubled down. He really doubled down. Today, he even said, we're going to use foreign assets as part of our sovereign wealth fund. Now, that would scare the bejesus out of me if I was a foreign holder of equities, real estate, treasuries, etc., because that is a major shift in policy, which will trigger once again the dollar falling. And so the problem is last time we had the dollar falling, it was post Trump getting elected, and it was very clear the policy that they dictated, right? That was going to be the dollar will lower with yields, with oil. Oil's already going to lower. That's been my call since last year. And yields are very sticky. So we're really not falling out of the Goldilocks zone. We haven't even gone down to my 4.1% in the 10-year this month. So anyway, the point is we did have the dollar fall because it's overvalued and because it's an absolute policy choice. And that's also helped equities tremendously. Inflationary assets, wealth holders, we're doing great. The problem is it's that K-shaped that's going really, really, really in a stretched, painful position for lower and middle class. There's no question about it. So that evidence is going to come and bite us in the butt at some point. But right now, blinders are on, markets keep buying. We definitely have, I consider, a melt up potential now. So grinding higher is one thing, that 6,500 that I printed in June. And my VIX level, remember that? What did I revise it down to? Again, June 3rd, I changed it. I said, okay, it's not going to be 1550, it's going to be 1458.
Yeah.
And we hit 1450, so we're there.
I think the VIX is interesting. I think I made this argument to somebody today. I said, now the VIX is 30 days. So it's very short-term oriented. So I find a lot of people kind of focus on it. Well, given all the problems we have 6, 8 months from now, how can the VIX be doing this? Well, you're talking about two completely different things. So I'm looking at longer-term plays. And so a lot of the people who follow me, a lot of members, I've been getting them into sort of longer-term plays. I think the long-term vols are very, very low. There's pricing out there, especially those upside pricing that just is really, really cheap. cheap skew, cheap options. And I really think my theory is that we're going into a phase over the next couple of years where, because of the things I talked about earlier, which is some massive winners and then some massive losers and incredible dispersion under the hood and really not knowing where we are, I find that people don't get it. This inference isn't, the training phase is one thing. Inference is around the clock, 24/7. It is, if you think of this as the internet, so I'm old enough, unfortunately, to remember, and I traded the internet boom in 95. I remember when Netscape came out, it was like, wow, this is really, really cool. What is this internet thing? It was right after I graduated from university, actually. So I didn't get the benefit of that in university. Now kids have AI. They have things just doing all their work for them. So I don't know how the schools are going to navigate that environment, but I saw it. And in terms of AI, I think we're kind of 96, 97. Netscape is launched and you've got the few adventurous companies, but the real adoption wave is really happening now. It's first inning. It really is. Like, I'm not saying stocks are just going to go up nonstop forever, because they didn't back then and they won't now. But this is literally the first inning of, this is a couple of companies figuring out how AI is going to help their productivity. This is going to go for years and years and years. So this is going to be absolutely massive. So it's going to be very, very interesting. But having said that, I've been moving out of technology. So I love it. I think we're going to get a melt your face off rally as well in the fall, I think, unless something derails us for a little bit, but it's coming. But in the meantime, I'm sort of going, okay, Palantir at 1,000,000 times earnings versus now we've got, look at the IWM acting really well. I have to admit, I sold some IWM lower. But I do own a lot of things that are very rate sensitive. We've talked about that on the show. So the Rockets, the Zillow, I know you followed Rocket as well, Samantha. I think you might have given me the idea, in fact. Fantastically vertically integrated company. If we start to see housing unfreeze, that is really massive. That is a big part of the economy. That's going to have knock-on effects throughout the economy. So some of those things are starting to act well. Now that we're up to 50 basis points, that kind of puts a little bit of a floor in a different flavor of both MAG and the rest of the economy. So MAG may be expensive, but the rest, there are a lot of stocks out there that maybe aren't that expensive and people have forgotten because it's all been about tech and AI. But things like Rocket, things like Zillow, which I was recommending in the high 60s, $84 now, these things are going to be AI plus real economy. And I think you can even play things like Apple. I think Apple's got an incredible bid to it. That is sort of a forgotten MAG that is now, if we are moving into, hey, the consumer is going to have a little bit of discretionary cash to spend again, and Apple hasn't gone anywhere as much as people get on it. It is AI in your pocket. There is no better company for AI in your pocket. So they're just literally one more decision away from being great. So you can see some strength in Apple today. Meta, Microsoft, they've had good runs. But yeah, I think there are interesting places you can maybe just do a little bit of a shift for a few weeks and focus on some of these sort of little bit more real world sensitive type areas.
Well, I'm going to have to take the other side of that just a little bit for.
I knew it.
I know. You'd be disappointed if I didn't.
I would.
Right? Okay, so what I mean by that is, you already know I've got my top 10 list that I update all the time for clients as it relates to the bullish bent. And this is fine if you are tactically trading, and then you want my warning of when we're going to see selling under the surface. We've got breadth divergence that creates an air pocket of risk. Take care, it's coming. Okay, and we're just constantly looking at that. Your VIX analysis also when to take care because a pattern will emerge in my growth rotation, what have you. But this AI hype is just over the top. So, we can see very clearly that this is not a normal market for the masses. NASDAQ market cap hits record 105% of US GDP in the second quarter of 2025. So this is 2000. Way to heck down here, you can't even see it. And this is obviously liquidity galore when central banks around the world were stimulating. Monetary policy was on the ground and fiscal extravaganza. In total, it was 27 trillion. Global central bank infusion. Anyway, AI extravaganza, we're here. So this is a little unnerving. Valuations are very high. And then you still have the Rick Riedels of the world of BlackRock, which obviously manages 13 trillion, saying this is a great setup for higher.
Greatest investing market of all time, didn't he say?
Yeah, exactly. Yeah. So you got BlackRock right as we approach that 6666 saying, come on, give it your best, get in there. All right, so let's just talk a little bit about this AI tech jubilee that I did write about as well, which is kind of down in this neck of the woods here.
But you have to say, Samantha, 2001 and 2021 were nonsense. These were stocks trading at 400 or 500 times earnings. There are a lot of companies making money. Now, there are some that our Palantir shouldn't be priced where it is.
Let's talk about what's making money. And this was whenever I did this for clients, July 31st. So it's not that old. Okay, so AI is going to help fiscal. It's going to solve everything, all kinds of issues. We're very, very, very hopeful. Fiscal deficits, it's going to solve cancer. I mean, this is the Elon Musk mantra. But let's kind of focus here on what I was getting to, and I'm making your eyes kind of crazy. But right now, 50%, when you talk about revenues, 50% of AI is currently monetized via gaming. That's where the money right now is being earned, is via gaming. Not stuff that Americans make us smarter. The opposite, or richer, the opposite. Only 3% right now is for productivity. That's the Apple Store. Meta bets absolutely are just, this is going to be the best thing ever made for targeted ads. And this is why their free cash flow was cut in half year over year. But bigger picture, Capex growth is still the trigger for higher valuations. You would not argue with that in any way, shape, or form. And yet, wouldn't you know, historically, this has been a huge, huge reason why tech has petered out after they've done this massive spending. So there's this period of now we have to absorb all this and show that it's actually going to work. So basically, big picture, I'm looking at China as an alter ego here that makes AI available for the masses. So they want their entire economy to benefit, not winner take all from Silicon Valley. And I know that you're very excited about the AI winner take all market domination in the US, which is exactly what we've got. But I have to preface it by saying that is not sustainable. So anyway, their model is very, very different. We don't have the same kind of communist and or altruistic bent. It is definitely a Silicon Valley wins and everybody else be damned. So just kind of preface that a little bit. This is becoming still a melt-up market that can become unwieldy. And the first sign of economic distress, if we're allowed to see it, such as employment, such as inflation, will absolutely create a big turbulence in this growth rotation, this AI rotation. So I definitely, and our electricity bills. So I mean, they're already going up dramatically on the aggregate in the US because of this. Also, it's like taking the Bitcoin mining focus for the AI data focus, and it's just creating higher costs right now. That is hitting disposable income for many. So just temper that enthusiasm. It's not really proven. And in fact, historically, it's been very dangerous to load in so much Capex into one theme. But it doesn't mean it's going to, we need a trigger to interrupt the flows, always.
For sure. And look, we're speaking as we're mostly traders here, but I try like you to sort of zoom out, zoom in, zoom out, zoom in, because I like to be informed by a kind of general secular theme or something that kind of keeps me, especially on pullback. I need to feel like I'm in something that makes sense, a story that has some legs. And so for sure, I mean, look, at some point, I do think the timing of it is interesting. I think this phase is kind of the warm-up pitch before the baseball game.
But you also have to admit there's also a hoax that we're supposed to believe that no damage can come to NVIDIA, for example. China has already turned after Trump said on again tariffs, off again, 100%, no, that's okay, you get an exclusion. Wait a minute, we're going to create a 15% hit to your top line. And then basically China just said, forget about it, we don't need you. NVIDIA was smuggled in anyway, but the point is we don't want your chips. We're going to actually put a ban on those chips coming into China. The point is the market doesn't price any of that in. The market isn't pricing in the lack or the loss of China revenue to NVIDIA or other sectors that are very much not, maybe not dependent on China, but in the case of NVIDIA, their growth in the US flattened out big time beginning of 2024. Their major growth engine was in fact China. So you take that away. When do investors actually price that in? They refuse to. So there's a bit of a hoax right now in believing that the market just doesn't accept the facts, that China doesn't see AI as a product, they see it as infrastructure, that China doesn't need NVIDIA chips. They have created their own ecosystem of players, and now they are telling their players, do not buy US products. So none of the US market is pricing that in because we've got percent coming out every single day with a new headline about looser monetary policy. It's a game. But just don't be complacent in playing that game. I know you and I, we look at this, we're in front of the freaking thing, computer screen 12 hours a day without question.
Yeah.
But most people are not. So that's why we do this. Okay, so we know
Right.
the market's bullish. I still see all the reasons, blah, blah, blah. And we haven't triggered my melt up level yet, but we could. And Trump tariffs haven't been priced in because Fed cuts, and DeepSeek and all the China independence from semis that has not been priced in because of 150 to 175 basis point cut that Besant is out talking about on Bloomberg today. No wonder markets turned higher. No wonder small caps spiked higher and yields softened. But I don't think that's sustainable. Big picture,
Yeah.
it's a hoax.
And that's it. Look, I'm not saying it isn't juiced, right? This is juiced. It's a house of cards that's been juiced for years and years and years. And so I'm just kind of playing the game, playing by the rules that I'm given. And having said that, I dumped a ton. I dumped my Nebius. I dumped a good chunk of, I think I dumped almost all of my Palantir, hoping to get in lower. I'm sure it's going to run up another 25%. I am moving out of some things and pushing a little bit more into names like Goldman Sachs and into, which I've loved for a while. It broke out to new highs again. So I have been telling people, some members have said, is it okay to get into these leaps? And I'm like, oh my gosh, we just ran up like 50% in some stock. And somebody's asking me, is it okay to get in? And I said, well, okay, what's your time frame? Like, probably better to wait. So I get excited about the overall picture, but I am still a trader. And I do remember in previous manias that you do get big, really ugly sell-offs. In fact, I remember I wrote it somewhere. I said, you're going to get a sell-off here at some point that will make you ill. It'll make you sick if you get stuck with very, very big position. And I said, don't make the mistake of thinking you're diversified across this and that and whatever. It's been like taking candy from a baby lately. We all feel really, really smart. Any AI stock we buy, we're making money on. Okay. So we have no illusions about that. But when the tide turns, now you've got 35 different positions to handle, and they're all doing the same thing as things correlate to one and go down. So be very, very careful. We've had a fantastic run. I did think we would have a little bit more softness in August and September, maybe seasonally, but I did kind of say, look, if we bounce back from that sell-off we had a few weeks ago, if we bounce back in a couple of days, I think it's game on again. And it has been. So it's just been so strong. It's been so absolutely strong. And I don't know if it's half of it is AI, half of it is maybe people haven't gotten back in. There's some sentiment indicators, Samantha, that still show that the so-called smart money is still kind of not so sure about, should we get in, should we push in? So it's been the most hated rally that I've maybe ever seen in my time. I know it's easy for me to say that because I probably don't remember some year and some period years and years ago, but it really is.
How do you judge hated? Because I see it as tactical on one hand, and then just the macro risks on the other, which keep the eye open. In other words, things to look for that don't smell right. And this doesn't pass the smell test, but that does not mean you ever short all-time highs. And by the way, fraud, I also have a saying, fraud always marks the top. So
CoreWeave, hint, hint. CoreWeave.
Well, no, lots of them. I mean, yeah, Magnetar and the rest are still feeding this whole engine, and it's beautiful exit liquidity. But I'm not talking about ever getting in front of that. I'm talking about that which is, I know you're talking about the hated rally, but I'm not clear how you define a hated rally, because they call it the golden age of grift, which it is, because they call it a Ponzi, a hoax. I mean, these are all labels, but it doesn't mean we're going to short it. We know better. You can't short a Ponzi. You can't short all-time highs. You can't, only until the gig is up. And right now, we don't have a macro trigger to interrupt the bullish flows. So why do you call it the most hated bullish rally?
I just think it's from a lot of measures, sentiment indicators, anecdotally skeptical, maybe not hated, but people are very skeptical. Part of that is probably the media. The media is very left. Everything Trump does is terrible. And I think they've really done a disservice. I was having this conversation with somebody today. I think they're really actually quite stupid. They've basically pushed everyone to think that he's doing a horrible, horrible job, but he's kind of pulling it off. It may be all a house of cards based on gas and no breaks for who knows how long it's going to last, but he's kind of pulling it off at this point. And so I think it's maybe kept some people, especially if you experienced April, you haven't gotten back in. That was pretty ugly. It was very ugly. It looked like the global economy was about to fall off the cliff. So it's been very slow for some people to get back in. And here we are.
Okay, so now that's a politicized comment then. I don't watch any news, like nothing, not anything, not Bloomberg, not CNBC. So therefore, I'm at a loss to know what the sentiment is. But I do know it's very politicized. There's no question about that. So we have, and for example, canning the BLS director and then appointing a Trump loyalist. Same thing with Stephen Mirren replacing Fed Governor Kugler, again, a Trump loyalist. All very, very bullish the market because they absolutely assume a dovish Fed. But that's politicizing a role in the government to enable the fiscal dominance to continue, which is, by the way, a short-term measure of excess and by definition speculation, which ends badly always. It's one thing to be tactically bullish, but I think the reason why they are bearish is because maybe politics is it, but it's also a really, really big precedence of running it too hot and then falling, aka 2000, which was a little bit different. 2008 was a credit event. We have a money bubble. We just have so much money. It's a big old money bubble. And they actually end the worst. They end in a currency devaluation. And then, of course, you've got an administration that is pumping Bitcoin, and that's its own area of sus. But
and Ethereum, wow.
I cover that every single day for clients. It's all part of this growth momentum. It is absolutely case in point for speculation and administration that is trying to get folks to speculate more, and that creates this continued money bubble. Now, the speculation, by the way, in stable coins, they're backed by nothing, but again, they're on treasuries. Their treasury balance sheet companies are using this. The Tom Lees of the world are using the MSTR playbook. This is all part and parcel of a money bubble that is approaching a melt up that we haven't even gotten to, which is shocking. So this is the warning. And anyone who has kind of been through this, and I don't mean 2008 or like you have been all the way to 1999, this is very different. So this is not a localized housing or tech or credit event. This is a money bubble. It's actually more damaging. What happens on the downside?
And from a trader's perspective, this may not speak to people do as investors holding stocks for 15, 20 years, but I'll tell you exactly the conversation that I just had this afternoon. I told a client, I said, my view is that we're going to get the melt up. And I think options are not priced for that. They're not. I was buying Ethereums and they're already at the strike. I mean, and I have like a year left in them. The options are not priced for a melt up with the skew and the levels of longer term vols. In the front end, you can see them kind of pushing up a little bit as the market sort of sniffs more melt up. But in the longer parts of the term structure, they're not. So, and my theory is that basically we're going to get into a who the heck knows what's going to happen markets. I think they're going to reprice. So my theory is that this is what I was about to say, but this is a little tip for people. If you want to position yourself, you can with some longer term options, you're going to be able to win three ways. And I said this on the same call. I said, listen, you buy some out of the money, say June of next year, April, something like that, September, maybe if you want to go the full year. And you're going to benefit three different ways if we get a decent move up, and especially if we get a melt up. The melt up is going to be a real game changer for this play because I believe long-term vols are underpriced. So if I ran a vol fund right now, I would be just positioning in a lot of those longer term ones because they're underpricing, in my view, what could happen. May not happen, but what could happen. You're going to win three ways. You're going to have delta, which is basically the direction of your calls, right? They should go up. If Microsoft goes up, you should benefit from the delta. You're going to also benefit from a move up in a melt up. What happens? We've seen parabolas, Samantha, over the last year. We've talked about parabolas. Vols go crazy. They go boom. Look what happened to Ethereum lately. The vols went boom. And I did a video a week and a half ago. I said, I don't understand why the vols aren't reflecting this. And they did. Eventually, they went boom. And so the vols went up and skew pushes up. So that upside skew goes bananas. You're going to win three ways because they're not quite pricing things correctly. So I said to this client, I said, listen, the way that I'm probably going to play this at some point is I'm getting out of a lot of my stocks. I'm getting out of Hood. I'm getting out of these things that are, now I'm sitting on nice gains, not on everything. I've got some stinkers in there too. Don't get me wrong. But I'm getting out of some of these winners and I'm repositioning in either upside calls, maybe some in the monies, like some sort of leap in the money, 80 delta, 85 delta. And I am adding downside protection like I have not added in a long time. So of course, you guys listen to Samantha and I, and it sounds like I think things are going to 10,000, but I'm telling you that the way I see it is the way that things could happen at this point is I don't think markets are just going to kind of meander. I think we're going to get to a point because of AI, because of fiscal, because of what you're talking about, this sort of irresponsibility of what's going on. We are coming to some sort of fork in the road. Is it next week? Is it 6 months from now? I don't know, but it's going to involve a lot of volatility. So I'm basically creating a massive, massive straddle of sorts, which is playing for upside and then having a big, big amount of protection in case the unknown happens. And they're going to be underpriced in that downside 100%. I can guarantee you that if we do get something break again. So I think there are ways that you can sort of reposition your portfolio to not be as, it doesn't have to be out of the money calls, because those can be, they can suffer, can collapse a little bit, even though I'm saying vols are low and skew is low, call skew is low. You can position in, there are better ways to do things. I was looking at, somebody asked that the same call, the guy said, I want to own granny stocks or whatever the heck it's called by Tom Lee. And he said, I think this could be great. And I said, yeah, it could be. And I looked at the option. I said, this isn't very expensive. I looked at these like 7 or 8 month out options. There's barely time premium. You could go into granny stocks for $24, or you could buy these in the money calls for $4. That you have way less risk on your book by owning something like that could frankly get cut in half at some point if there's another deep seek moment, or who the heck knows. So there are ways you can be a little bit smarter. It doesn't always have to be hedging with downside puts or downside put spreads or VIX or whatever. You can literally put yourself into long positions that are a little bit less risky. You're going to put a whole bunch of cash in your jeans at the same time, just in case. So there are fun ways that we work with clients at LaDuc to basically show them, listen, you don't have to do things the same old way. There are interesting ways you can do things.
I agree. But I'm more of a market timer. So I'm waiting to see the degradation of selling underneath the surface. And the biggest tell for me is, I'm going to know it when I see it, but right now it hasn't come in. My growth rotation is not done. What can I tell you? I just like,
What's our warning? What's the warning?
But all of the other stuff, we're going to go and answer some questions. But for me, I'm going to market time it. So I don't have this way out of the money calls and puts as a hedge. I'm going to trade it tactically when I start to see the weakness underneath the surface. And that might not be a good idea given what your risk is as it relates to an air pocket. Like, for example, if we don't get above my level that's tagged once, but it hasn't gotten above, and I'm not talking about SPX, but it's an internal read that my clients know about, we could absolutely drop down to 5,800, poof, just like that. There's an air pocket down there, okay? Yeah. Really, it seems like it's unfathomable, but we definitely have some area of chop that we could start to hit. And remember, my time frame was this VIX 1458 by August 15th. Well, that's in 2 days. I was probably a little early on that because I think we could probably go down to 1410, and it's probably by August 20th, which is the expiry for VIX next week. So whatever, it's not a game of perfect. But if we get above this particular indicator, we can fly up to 7,000. Yeah, we might take a little stop at 6666, but the point is we have the boosters engaged. So I'm still waiting for that. And I'll see the pressure kind of build up, or I'll start to see it peter out underneath the surface. That's my own kind of technique. But in answer to your question, how important unemployment reports, it's critical. It's absolutely critical. And that's why we got the revision last year causing the 50 basis point rate cut. This year we got revisions, but we're not going to get a 50 basis point rate cut unless they goose those numbers to the downside just on purpose to get Powell to concede or for Powell to capitulate. The problem is there are no good employment reports. And this is something I talked about. I have a weekly interview with SiriusXM, and Janet was asking, so what are you going to use? And I said, it's a problem because economists are so used to this state level funnel to the federal, and the federal provides the jobless claims and continuous every week, and then the non-farm every monthly. And we don't have transparency or trust into those numbers anymore. It's disconcerting. So that is not going to be replaced by, and a lot of people have tried, and I've kind of discounted this, debated this, when they start to use tax receipts. Tax receipts are not a good tell for employment because 97% of taxes are paid by 50% of wage earners. So you get a big whole 50% that's not even counted. And then FICA, which is Social Security, everyone has to pay that. Well, guess what? It's inflation adjusted, so it went up, and there's also a max limit. So you're also excluding the upper income wage earners. At the same time, you're literally counting inflation, rate of change. It's useless. Well, it's very poor. It's not useless. It's just poor. So there really is not a great substitute out there for us to use, if truth be told, for unemployment. And that makes it very unnerving not to have something to really tell what's going on. We can tell with credit spreads. We can also tell by inflation and disposable income using other methods than what data is provided because of CPI being estimated, or because they pull out stuff because it props it up too much. So we can get around and do inflation data reports outside of CPI and disposable income and prices. Like export prices are coming in this Friday. That'll be a good tell. It's not manipulated so much. But we can pant for unemployment. It's really frustrating what they're doing.
But what are they doing with those numbers?
Forgive
They
my rant
revise
on that. It's a big deal, long
they
story short.
revise them all the time. It sounds like they can't figure them out to begin with. Like it's
No,
just
no, 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 that's wrong. It's actually because small, medium, large companies in the field are reporting and they have a deadline to report. And sometimes they don't. They miss the deadline. So you have to go wrestle those suspects up and say, hey, give us the numbers. And then they do, and it's after the fact. And so they have to revise it. Now, sometimes it's political, like that big, huge hit back in August of 2024, right before the election. All of a sudden, they collected all of the data for the whole year. And it was 818,000 lower, which prompted the Fed rate cut to goose the markets before the election. Now, I cannot dismiss that that is very suspect, but the revisions are not new. This is a feature. You got to get the data out of the field, and they're slow to report it, the companies themselves. So anyway, yeah, I answered that question. ADP are not great. Indeed, not great. Jolt's not great. It tells you about the fact that they're hiring less and firing less. Okay, that's helpful, but that's not unemployment. Anyway, hedging now, you already got Hans's excellent assessment on hedging, staying long, but still hedging. That's great. Hated rally because people aren't in it. They said the same thing with Trump back in 2018. Remember that? Oh my goodness, the drama, the grip of despair by people who missed that amazing rally. So maybe that's why they're still hating it. And you have a question. You have metric for this vol. Do you have a metric for the skew?
Oh, for the skew. Well, I mean, it depends on what you're looking at. So there are some tools out there, very easily accessible tools where you can look at upside skew. There are a number of products, so it's not too hard to find, but you're going to want to look at sort of some products will give you kind of at the money implied volatility, and some of them will give you the skew. Well, what do those out of the money calls look like versus the puts? So for example, we're going into, actually, I wanted to show you guys this. We're in a very high skew environment again, which is when somebody says high skew, that implies the puts are steep versus the calls. Low skew is the opposite. The calls are starting to pick up strength. So we've seen that, for example, in Ethereum, as it is melted up, we saw the call skew go up. So suddenly everybody gets excited. And so I've shown these charts before. The Ethereum skew looks a little bit exhausted to me. It feels very strong. They keep going. I think it will eventually, but it feels like people are getting a little bit too bulled up. So sometimes it's fun to look at the calls versus the puts. I should show you guys that because that's part of why I think maybe Ethereum kind of finds a bit of a top in here. Maybe not the very top. Who can call
show
that?
us, but I think I know what you're talking about. While you're doing that, I'm going to looking for that. I want to answer a question. You just said Hood, Schwab, and IBKR were all down big today. Maybe it was an earnings release. Same reason why I didn't realize at the time BJ's was down because of Amazon delivery news that I had missed. Anyway, momentum unwind or signs of something more. Typically, brokerages tend to go up right before melt ups, not down. Very good point, because do you know why? My theory anyway, margin. Oh my God, do they make money on margin? So when margin starts to roll over, watch out. So if you really, 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 really want to time trend directions, track margin, not when it's going up, when it starts to roll over. Track margin.
I was going to say, you mentioned margin, and I thought, boy, profit margins. They keep talking about how AI is going to really juice.
Oh, I'm talking about margin
no,
borrowing.
you're talking about different margin there. But I was thinking it can work both ways in the margin world. It's Salesforce and Visa, they're going to be facing compressed margins at some point. So AI is going to, on the one hand, with a company, that's why this is going to get a bit more difficult in this game of investing, because you have to kind of figure out. Goldman, for example, I think uses AI to really, really juice margins. A company like Salesforce or a Visa, which used to have a big moat, and maybe with stable coins, it's not going to happen right away, will be facing margin compression. So there's going to be a sort of two worlds of profit margins out there, which some are going to help the market and some are going to hurt the market. It won't be that clear. And because of this sort of age of disruption that I think we're going into, I think investing is going to be a little bit more difficult. You're going to need people like Samantha and I to kind of help guide you. This sector's okay, this one isn't, because I see people going, well, I don't see the problem there. I'm like, well, I'll tell you what the problem is. Think about it. Sometimes it's just sort of logical. So here's CTA exposure. Look at these guys. They're right back in here. Let's look at the vol targeting, and then I'll show you the skew information. Here's vol targeting back to the 96th percentile. So these are some of the mechanical flows that we talk about sometimes, which is they're all out and then they're all back in again. You do have those flows still exist to some extent, but they're just nowhere near what they were when the VIX was going from 40 down to 20. It's a different reality.
Can I make a pitch real quick for anybody who want, and I have no affiliate fee. I'm just telling you where where I get my information that's real time. Or I should say it's updated every day. Anyone familiar with Gamma Lab? I think it's a great tool. There it is. Now you're showing Nomura's superb data. If you are looking for vol control positioning, for example, yeah, so Gamma Lab IO provides this. You can get systematic CTA positioning. So you can kind of see massive, massive intervention here, April 19th. And CTAs are just buying, baby. Now they start to peter out a little bit, but they haven't really rolled over. So anyway, if you're looking for more updated charts, this is what I use, all I want to say.
Let me show the folks what I use for one of the things that I use. I do use something else mostly, but this is pretty cool because this is free. So if you go to Market Chameleon, I have no affiliation with them. They're very good. Yeah, good stuff. I don't know if it's like super cheap, but this is a free feature. So you can kind of see the skew here. And I love how they present it because if you look at this, so I'm going to show you, this is the SPY. So the zero line is where the implied volatility of the out of the money put and the out of the money call are the same. They use 25 delta. If we're sitting at the zero line, that means there's no difference on the skew. It's flat. If you see anything above the zero line means puts have gotten very expensive. So you can see in April as everyone rushed into puts, this puts got very, very expensive. So some people use that as an indicator to sell puts and buy some upside finance, things like that when they get expensive. Easier said than done when the world is ending. But I'm saying this, some people use this sort of tool. Now, some things will drop below the zero line, which means calls are more expensive. So Ethereum, for example, here's Ether. And you can see this is the zero line. So you always have to know where the zero line is. So anything below here means calls are expensive. So right away, you can deduce that this kind of product rarely ever has puts more expensive than calls. So that makes sense because it's a bit like a gold. It has upside explosive potential usually. And so it reflects that in the fact that calls are usually more expensive. But look here, this is where people got really bulled up and we're almost there again. So this is something that I've used on MSTR and things like that in the past. If you see this get down to here, that means people are super, super bulled up. They're short covering, whatever reason they have to get into calls. It's getting very, very steep. And that sometimes is an indication of exhaustion. So I talked about this a couple of weeks ago and I said it was sort of here. And I said it shows excitement, but it doesn't show exhaustion. So there's a little bit of art and science to it. Here, they're excited. Here, they've overdone it. So that's kind of one way that you can play this. And then the more typical way you're going to see skew is like this. Here's your smile. Sometimes it's a smirk on the SPY, but on Ether, it's a smile because you get steep skew down, downside puts, and you get steep skew on the upside calls. And that just means they're paying a lot more implied vol for those way, way out of the money calls and puts. And then the other interesting thing I thought, Samantha, you might like this. I just got this not long ago. I'll send you a copy. But here we can see, look at this monetary fiscal policy from QE to QT and back towards easing again. So here's the QE era where skew was expensive. So they're basically going along the market and just owning protection. They're like, well, Fed doesn't want stocks to go down, so I'm going to listen to them and I'm just going to go to the wall long. And then so we had this period here where maybe there was a little rethinking of that. But what Nomura is making the case for is that are we heading back into the easy policy era where it's going to be long and hedged? And that's what they're sort of showing with this green here is, are we going back to something that looks a little bit more like this? We shall see.
And we are very hedged right now. So this is something I share with clients from last week in my intermarket. So as we are traveling higher, the market is hedged. So it's not like shorts have all covered and the market mechanical levers are still in play, et cetera, et cetera. Earnings were great. We got all kinds of reasons, macro, fundamental, technical, that keep giving a lot of support to markets. But also while they are so great, there are a lot of hedges on. They're literally playing this rule book of staying long while hedging short. I can see this very clearly in my analysis. So anyway, an answer to your question, we have lots of tools. Market Chameleon, I have known since they started. Gamma Lab IO since they started. Spot Gamma since Brent started. And we are power users of Spot Gamma. I mean, our whole team uses it from their founders report to their matrix. Everyone has their different tool preference that they use from Spot Gamma, but I like different views. And this is why I have Trading View and I have TC2000 and my trading platform and my stock charts and my, so anyway, I'm showing you different views because I happen to like that CTA view. It's nice and clean. And also in Ethereum, let me just show that chart real quick because this is the one everyone's talking about. I had started showing this way back yonder when it got back above. This is Ethereum. And anyway, long story short, this big, huge wedge of 4 years, it kind of like like fake breakdown, and then it's a fast reversal. And then once it got inside, I'm like, okay, just wait for it, wait for it, wait for it. Because once it gets into this kind of 37.50 area, when people are now getting a little bit nervous because it's approaching the prior October 2021 highs, I still have the opinion it's an if then. If it can hold basically this apex, which is around 32.50, it can double. So I had the same call with Bitcoin up into about 135. And honestly, I think that can still be in play probably by October. And as it relates to shake and bake, I do see some end of October, like I said, that kind of VIX 1450 area that I've been talking about into the August expiry. So we got that next week on the 20th. We definitely have end of September risk with potential government shutdown. So it's not going to be an easy one to play. Also, earnings. I think Q3 are going to disappoint. We had hot fire flames earnings for Q2. Wasn't surprised. Q1 and Q2. Now we get to see what tariff impacts are. A lot of ordering, but a lot of expectation has been pulled forward. Q3 should be tepid. So if it's not, another reason for breadth expansion. But right now, we've got a little bit of risk into the end of year on the employment front, unless they hide the employment front. And then the market will say, make hay while the sun shines, and hedge to the downside for when something does come in and surprises. But I think we answered most of the questions. There was one I think I missed. Jay has a comment saying, yes, he's in Redmond, Microsoft backyard. People are losing jobs slowly. No more new software jobs available for new grads. Realtors are getting worried, and overall the dominoes are going to fall. And then there is the erosion of privacy, free speech. Yeah, there's always a tyranny aspect of all this bullishness. That's what worries me, is winner take all. But anyway, every time Percent speaks, it looks like he and his friends are not done fleecing. It's true. It is a little bit of a, man, this just seems very, very applicable to the asset holders, but not necessarily the blue collar, which is what they keep pounding the table about. I will absolutely fight. It'll be the hill I die on, having grown up on a farm, that this is not beneficial for blue collar. Tariffs are absolutely a regressive tax. This inflation that they are hiding is absolutely a regressive tax, and the majority are not taking advantage or able to take advantage of house inflation and asset appreciation and so on and so forth. So long story short, that's my big bugaboo. But anyway, that's it. That's a kind of a commentary that you have made. I've made mine. We still have a market that's bullish. And basically, until we see the growth scare, dependent on some macro news, mostly unemployment, I would say, or inflation. Inflation right now is being suppressed, and so is unemployment.
Something tech related. It could be another DeepSeek. It could be people aren't finding a lot of value in ChatGPT, or I mean, it could be anything. But yeah, it has been amazing.
Dollar falling, yields I think are going to get supported on the 10-year at the 4.1 area, and then we're going to see a bull steepener in the 10 and 2-year yield curve, and that's going to interrupt inflation or unemployment spikes. Those are going to interrupt. But for right now, enjoy your summer. And we'll be back next Wednesday to talk about whatever else happens in the interim. But also, Hans, of course, we have a fabulous option course for those who do want to get into the nitty gritty and protect portfolio and or just drive this alpha that we've got right now going on and do it safely. So he has a fabulous course on our website. Check it out, both course and mentoring, and the service, which provides access to 10 subject matter experts and active traders and analysts. So we invite you as well to LaDuc Trading. Have a great afternoon, everyone, a great weekend, and see you next Wednesday. Cheers.
Cheers, everyone. Thanks. Bye, Samantha.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.